Okay, let's dive right into a massive structural shift happening right beneath our feet. In this explainer, we're unpacking how the smartest money in the global market is quietly, but absolutely aggressively, rotating out of the abstract world of software and pouring straight into hard physical reality. It's really a story about physical limits, real-world infrastructure, and exactly where true power is heading over the next decade.
We're going to break this whole paradigm shift down into 5 quick stages. 1. The smart money exodus. 2. AI's physical reality check. 3. The ecosystem backstop. 4. The revenge of boring infrastructure. And finally, stage 5, the hard asset era. Let's kick things off with section 1, the smart money exodus.
So to really understand where the broader economy is heading right now, we first have to sort of pierce the illusion of our current stock market rally. Broad market indices are hovering near record highs, which obviously makes all the headlines. But here is the vital metric you actually need to pay attention to. Right now, fewer than half of S&P 500 stocks are actually going up. That exposes some seriously hollow momentum. The surface looks super shiny, sure, but the foundation holding it all up, it's incredibly narrow.
And the trading volume tells the real story here. Everyday retail investors are essentially propping the whole thing up. Meanwhile, institutional volume has practically vanished. Why? Well, macro stressors, things like weak jobs reports and a stubbornly high 3.5% inflation rate, are completely freezing the smart money. Institutional investors are slamming on the brakes, while retail just keeps on driving.
Which begs the question, where is all that institutional capital actually hiding? Well, instead of chasing ridiculously expensive tech stocks in an unpredictable market, institutions are pivoting to ultimate safety. They're locking in a guaranteed 3% inflation-adjusted return on long-term treasuries. When equity valuations are this stretched, those guaranteed real yields act as a massive portfolio buffer. Basically, the smart money is choosing boring certainty over shiny speculation.
And that flight from risk brings us to section 2, AI's physical reality check.
Now, this institutional pivot away from risk leads us right to the doorstep of the biggest, most capital-intensive tech boom of our time, which is, of course, artificial intelligence. We've all been conditioned to think of AI as this magical software living infinitely in the cloud, but we really need to clear that misconception up right now. The cloud isn't floating in the sky. It's a massive, incredibly noisy warehouse sitting on the ground.
The reality is, AI is completely trapped by physical constraints. To make it work, you need colossal, real-world investments. We are talking about Meta committing a staggering $130 to $145 billion just for data centers. Intel is pushing a $20 billion compute expansion. This isn't just abstract code anymore. We're talking concrete, steel, silicon, and absolutely massive cooling towers. Moving into section 3, the ecosystem backstop. Building out all of this physical infrastructure requires an almost unimaginable amount of capital. And here's how that financial machine actually operates. First, Wall Street heavyweights, think Apollo and BlackRock, inject massive capital, creating this $500 billion funding pool. NVIDIA then acts as the central hub, essentially the clearinghouse for that money. The funding flows right through them to cloud providers and AI labs, who then buy the hardware they need to generate returns. It is a highly interconnected, totally circular machine. But there is a severe risk alert embedded right in this structure. This circular financing is brilliant when things are booming, right? But it's also highly fragile. Because if end-user demand falters, say everyday people and businesses just decide they don't want to pay for those AI subscriptions, well, this entire web of hardware financing is completely exposed. If the customer stops buying, that feedback loop violently reverses. And honestly, even if the financing holds up perfectly, the AI revolution is just slamming straight into harsh terrestrial limits. These data centers are incredibly thirsty and absolutely power hungry. We're now seeing severe water usage threaten drought-prone areas like Texas. Extreme energy consumption is pushing local power grids to the very brink of failure. And the localized noise and pollution, it's triggering intense, highly organized community resistance. So to keep this physical build-out alive against all that public pushback, tech giants are being forced to play defense. It's no longer just about writing revolutionary code, it's heavily about public relations. You've got Mark Zuckerberg publishing a 6,500-word PR essay to ease public fears, while simultaneously, Meta deploys a massive $1 billion defensive fund just to quell community resistance in the towns where they're trying to build. Talk about a massive reality check. Which perfectly sets up Section 4, Revenge of Boring Infrastructure.
Because these glamorous tech companies are hitting these harsh physical walls, the balance of economic power is shifting entirely to an unexpected, traditionally overlooked sector. When you compare the highly speculative world of AI against traditional regulated utilities, the contrast is just stunning. AI relies on speculative capital and faces growing public backlash. Meanwhile, traditional infrastructure offers exactly what that smart money is so desperate for right now: long-term contracts, predictable regulated returns, and essential grid resilience. Suddenly, the quote-unquote boring companies hold literally all the leverage.
And we're seeing legacy utilities like Exelon act accordingly. They aren't just blindly accommodating the AI hype anymore. Instead, they're acting as incredibly strict gatekeepers. They aren't just handing over power. They are demanding millions and sometimes billions in upfront cash collateral from AI companies before they even allow them to connect to the grid. This is absolutely crucial because it protects the utility and everyday retail ratepayers from shouldering the massive speculative risk of these tech giants.
We can clearly see the geographic epicenter of this physical rotation happening down south, in a massive migration that's playfully being dubbed Y'all Street. Financial human capital is migrating heavily to Texas, bringing explosive growth and establishing huge new physical anchors, including the push to literally build a brand new Texas stock exchange.
But even in Dallas, which is wild because JP Morgan Chase remarkably now has more employees there than they do in New York, this hyper-capitalism is colliding head-on with harsh physical limits. There's a massive friction point here. Texas's aggressive economic growth is being directly threatened by this competing data center boom, which is rapidly draining state water supplies. And look, you can have all the capital in the world, but if you run out of water, the servers shut down, period.
Let's bring it all home with Section 5. The hard asset era.
All of this data leads us to one definitive, inescapable conclusion about the next decade of the global economy. We are fundamentally transitioning paradigms. We are moving away from the fading software era, a time defined by infinite scale and valuations that were completely detached from physical reality. And we're stepping straight into the hard asset era. Growth is no longer infinite. It is entirely gated by access to copper, water, and power. Regulated utilities and hard assets now hold the physical keys to the future.
So, as we wrap up this explainer, I want to leave you with this final provocative thought. The winners of the next decade will not be those who write the best code, but those who secure the most power, lay the most fiber, and build the most resilient grids. In a world completely obsessed with writing the perfect artificial intelligence software, are you paying enough attention to the boring companies that actually own the power switches?